Serious questions are being raised over Google's massive acquisition of Motorola Mobility. Standard & Poor's is downgrading Google from a buy to a sell, cutting its price target from $700 to just $500. Google stock fell on the news, continuing to erase gains made after the search giant launched its new social network, Google+. On Monday, Google agreed to buy Motorola Mobility for $12.5 billion, the largest acquisition in its history. Motorola now holds more than 17,000 patents that may help protect Google's Android operating system from ongoing litigation. But Motorola is, at its core, a hardware company making smartphone handsets and set-top boxes. So the big question is, how will Google integrate this acquisition? And if it overpaid, will the deal be a drag on future earnings? For more on the logic behind the Google downgrade, let's go straight to New York and Scott Kessler, who heads S&P's tech equity research. So, Scott, you dropped a bit of a bombshell this afternoon. Why do you think this deal is a bad one for Google?
Well, we think there are a number of reasons why investors should be, at the least, asking questions and perhaps even more so reconsidering their investment in Google at this point. Number one, the company indicated they plan on closing this transaction in early 2012. Honestly, I can't remember any deal of size Google has done that hasn't taken 9 or 12 months to be consummated. Number two, we look at this deal and say, well, it's great that they're thinking about protecting Android and the intellectual property, but there are multiple matters in play right now that we don't think will at all be affected by what's going on here potentially with Motorola Mobility. Third, we think that despite the 17,000 patents that you referenced and the 7,500 patents that are pending, the reality is no one knows to what extent a pile of patents is going to protect Android going forward. And then fourth, as you referenced, Google and Motorola Mobility are fundamentally different companies. If you look at Motorola Mobility, you're talking about much more limited growth, significantly lower margins, and frankly, a company that's going to also have an adverse impact, obviously, on Google's balance sheet. So for those reasons and more, we think it's worth selling Google right here.
Now, Scott, is there anything that Google could do with this acquisition? As you say, they're very different businesses. Is there anything that Google could do with Motorola that would make you more optimistic about this acquisition? For example, there's been talk about Google potentially winding down the handset business.
Right. Well, Emily, it's really important to consider that a number of folks have floated possibilities, right? All we know are the facts, and that is that Google announced it's buying Motorola Mobility, the handset business, the smartphone business, the tablet business, the set-top box business, everything. And while we think it's a possibility, that's sure. Really what they're interested in is the patents. And sure, they could look to sell some of these other businesses, but we see a lot of challenges even if they were to pursue that avenue. For example, who would the potential suitors be? And would federal laws related to foreign companies and countries having interests in our communications infrastructure and equipment have some type of impact about Google trying to sell these businesses? We think, frankly, it's a tough sell any way you look at it, and we just don't see it happening.
So how do you think this is going to negatively affect Google's growth?
Well, it's pretty obvious. I mean, if you look at Motorola Mobility, pretty impressive growth of late, but Google has been growing revenues at a much higher clip over the last number of quarters. And then, oh, by the way, if you look at operating margins, which we tend to focus on, Google has been tracking 35 to 40% over the last number of quarters on an adjusted basis. Motorola Mobility, you're talking about low to, at best, mid-single-digit operating margins. So by definition, when a software company, an internet company, buys a hardware communications equipment company, you're going to see a substantial degradation in that company's margins. There aren't any two ways about it.
Scott, does this purchase make you doubt Larry Page's strategy?
It doesn't necessarily. I think Google's management, led by Larry Page, they have the luxury of taking a very long-term view. And they see that there are significant potential positives over the very long term of doing this type of deal. We obviously look at things on a more micro basis, and we say, you know what, there are some substantial risks at best, not even assuming all of the bad things that could accrue as a result of this. The other thing, which we haven't even talked about, is how is this going to affect perceptions related to Android? It's been so tremendously successful. Why? Because it's open source, it's free, and it's gotten buy-in from a tremendous number of OEMs, including Motorola Mobility. So if you're Samsung, if you're LG, if you are HTC, when you're very reliant on this operating system that now is being partnered with one of your primary competitors, you might start thinking about a plan B. That can't be good for Android and arguably can't be good for Google either.
We will certainly be watching how those other handset makers, Samsung, HTC, LG, all respond to this move by Google. Our thanks, though, to Scott Kessler of Standard & Poor's.